What is up everybody, Yasin Nizami here and I am back on this channel. I took a break since July. I was busy with some of the personal stuff, but now I am back and I'm going to continue putting some content out for you on real estate, finance, macroeconomics from Canadian lens perspective so that you can make an educated decision about your financial decisions. So in this video, I'm going to cover what's happening in the Canadian real estate market, particularly in GTA, how the rate hikes are kind of shaping the way the market is going to move in the next 6 to 12 months, and what is the economic outlook out there given all those geopolitical tensions that are going to impact our economy here in Canada as well. So without further ado, let's dive in. The numbers from TREP came out last week, and according to that, we are seeing a 44% decline in the sales volume compared to last year. That is a significant sales volume decline in the last 20 years. We haven't seen that in GTA market since the last financial crisis happened in 2008. And this is not about just the pricing, it's about the volume, the momentum, the sentiment between sellers and buyers, because since the peak back in February, we are seeing that prices declining month over month basis, but at the same time we are seeing the transactions, the number of sales volume is also going down. And we saw that there was a period where the distressed sellers were trying to dump the property because they were already stuck in a transaction that they wanted to close, and that was basically pushing them to sell the existing property at a discount rate. That period is now gone, and now we are seeing the sellers are coming up with no compelling reason to sell. They're just testing the water, or they are setting the price bar and telling themselves, I'm not going to sell the property below, let's say, 1.2 million. So that is kind of the sentiment in the market right now, and buyers are not reluctant to pay more as well, and primarily because of the rising interest rate, because the rate when they are rising, it is making the mortgage qualification quite difficult. Like when you look at the stress test today in Canada right now, the new applicants are being stress tested at 7%. That is a huge qualification threshold that someone needs to meet in order to get qualified for the new mortgage. And then when you look at the current rates right now, it's approaching 5%, and with the next rate hike cycle, they're going to go above 5%. Like fixed is already above 5%. The variable is somewhere between 4.5 and 5, but with the next rate hike cycle, the variable will also jump above 5% as well. So when you see these rate hikes are continuously going up, this is making not only the qualification but the existing monthly payments pretty much unaffordable for an average Canadian, because when you look at the current dynamics, the market in GTA and Greater Vancouver area, they're not built to sustain these higher rates. And when the rates are aggressively going higher, then of course it is making the affordability even worse. And when you look at what's happening in the US, the Federal Reserve has openly said they are not going to stop until the inflation comes down or until the unemployment goes up. So they are technically trying to create a recession by increasing the unemployment numbers, because that's the parameter that they see in terms of the Phillips curve. Hey, theoretically the unemployment has to go up in order to bring the inflation down. That's their theoretical model, and they're basically looking at those numbers, right? So if the inflation is not coming down, then they're saying unemployment has to go up and the economy has to slow down, which means exactly they are causing recession in order to bring these inflation down. So Federal Reserve is very clear, they're not going to stop until these things happen, and most likely Bank of Canada will also follow the suit, because Bank of Canada works side by, in lockstep with Federal Reserve with regards to monetary policy, and I don't see this is going to get any better. And when you see the rates are kind of staying, between 4.5 and 5 and 5.5, And if it stays at that level for another year or so, I'm not saying the housing market is coming back in terms of the price appreciation anymore, because the amount of debt that we see in the system, what I mean by that is the consumer are heavily indebted. When you have heavy debt on the consumer, every rate hike is going to make their life even more miserable. And if you don't bring the rates down, I don't see the price appreciation element will come back into the real estate market in GTA or in Greater Vancouver area. The interesting thing is the inventory levels are historically low right now. So we don't have a lot of options available in the market, which means the buyers that we have available, they're genuine buyers. They are looking to buy a property for their own self. They're not like investors trying to flip. They're basically genuine buyers who would like to purchase property to live in. But because we don't have a lot of options, we're seeing the prices kind of staying at that level. So the market is still very tight because of the low inventory, and we don't have a lot of buyers either. But whatever buyers we have, they're trying to buy these properties at whatever cost it is coming at. So this is the situation right now. The market's still very tight because of the lack of inventory, but then rising rates are making it even more difficult for qualification and also to sustain the monthly payments going forward. So I see the rate hikes will continue at least until this year and maybe at the beginning of 2023, and then they will take a pause and the rates will stay that way until the inflation slowly comes down. Keep in mind, the inflation doesn't come down like overnight, and similarly the real estate doesn't move overnight either. So the price decline process is going to take months or maybe sometimes years. Like when we saw what happened in 90s, it took 7 years to hit the bottom, right? So it's going to continue, grind the entire sales process, because we're not seeing those elements that is going to uplift the market in a healthy position. Even though we are seeing immigrants are coming up, look, the number of immigrants that came in the last 12 months, these are exponential compared to the last 10 or 15 years. But even that volume of immigrations are not basically helping the market to lift itself, because they have to take mortgage. They're not bringing cash to buy the property, right? And the mortgage qualification is depending upon the rates and the monetary policy, which is also going to tighten the overall lending process. This will definitely slow down the market going forward. That's it from me for now. For this week, I will continue posting videos every week on these topics. So if you would like to ask me any question, put your comments down below and let me know what else you would like to hear from these videos. So I will keep an eye on that. So until next week, take care.